Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today we are doing a really deep dive into something that honestly might be the biggest structural shift we've seen in the economy this century. And I'm not talking about just, temporary recessions or the usual rate hike cycles. We are looking at two huge, and I mean permanent, changes that are happening right now in late 2025. And they're totally redefining how value is created and really how prices are set across the globe. So our mission today is to break down these two new realities. First, this incredible ultra-concentration we're seeing in the stock market, this whole winner-takes-all world driven by AI. We're calling it the era of super gap. And second, and this is tied to the first, we have to look at this fundamental reversal in global pricing. It's being driven by a policy out of China, and it really signals the end of an era of cheap goods. You absolutely need to get your head around both of these to succeed in the next decade.
That's precisely it. I mean, recent analysis is pretty clear on this. If you as an investor are still using the playbook from, say, 2015, relying on broad diversification, expecting inflation to stay low forever, assuming rates will always fall back to zero, you are going to be at a huge disadvantage.
So these aren't just headwinds.
No, not at all. These are deep structural realignments in how capital works. We're moving into a time where both how we value companies and the basic cost of doing business are being reset. It really demands a complete rethink of your portfolio.
Okay, let's unpack that concentration story first then.
Yeah.
When we say the market is concentrated, I think most people's minds go to, oh, the M7 stocks are just really big. But the data we've been looking at suggests we've blown past simple concentration. It's something more, I don't know, maybe more dangerous for the average investor, this era of super gap. What makes it so different from, say, the dot-com bubble?
It's the speed of it, the sheer breadth of the gap, and the technological moat these companies have built. I mean, it's creating a massive and frankly unhealthy disconnect between the headline you see on the news and the reality for most stocks out there.
So you see the S&P 500 ticker go up and you think everything's great.
Exactly. You think the whole economy is booming, but the reality for 90% of those other companies is stagnation or even decline.
Let's start with the hard numbers on that then. The data is current as of, late November 2025? Tell us about the S&P 500 hitting these record highs, but why we need to sort of ignore that shiny number and look underneath.
You have to. You absolutely must look past that headline number and check the underlying health of the market. And the key indicator for that is something called the advanced decline line, the AD line.
Okay, so for our listeners who are really trying to build up their financial literacy, can you just remind us what exactly the AD line is measuring and why is it a better predictor of market health than just the index price?
Of course. So the AD line is just a running tally. It measures how many stocks in the index are actually going up versus how many are going down each day.
So it's about breadth.
It's all about breadth. If the main index is rising, but the AD line is flat, or even worse, falling, that tells you only a tiny handful of stocks, usually the biggest ones, are doing all the heavy lifting.
I see.
Think of it like a baseball team. The scoreboard, that's your S&P 500 index. It shows the team's total runs, and it might look great.
Right.
But the AD line is like looking at the individual batting averages for every player. If only your top 3 batters are hitting home runs, but everyone else is striking out, the team score still looks good for today.
But the team itself is incredibly fragile.
Exactly. That lack of broad contribution means the team is unhealthy, right? It's not sustainable.
And what's the data telling us about that foundation today? Is it fragile?
It's razor thin. The AD line is lagging the S&P 500 by a really significant margin. Historically, that level of divergence is a major red flag. It signals the rally is not broadly supported, and it's relying completely on this ultra-concentration.
Can you put a number on that for us? How concentrated are we talking?
So as of late November 2025, the top 10 stocks in the S&P 500, that's your M7 plus a few others, now account for over 36% of the entire index's market cap.
Wow. 36%. That's a genuinely historic number.
It's staggering.
To put that in perspective for everyone, if you own a simple S&P 500 index fund, that means almost $4 out of every 10 you've invested is tied to the fate of just 10 companies.
Yes. And just to compare, during the dot-com peak in the late 90s, that number was closer to maybe 28-30%. We are in totally uncharted territory here.
And the implication of that is just massive.
It's huge. It means the performance of those 10 stocks basically decides what the entire market does. The other 490 companies could all have record profits, but if the M7 stocks drop by 10%, the whole index is probably going down. That's the reality of this super gap.
Okay, so when the market gets this narrow, this top-heavy, we often look to the legends for some perspective. What is Warren Buffett doing? His behavior has to tell us something about where we are.
It tells us everything. And his actions are speaking so much louder than any public comment he could make. His company, Berkshire Hathaway, has given us the ultimate signal of caution.
Which is what it...
The data from the end of Q3 2025 shows that Berkshire has piled up a record-breaking amount of cash. We're talking over $200 billion in cash and cash equivalents.
$200 billion just sitting there. While the market is hitting all-time highs, that seems to fly in the face of everything you're taught about investing. Always keep your capital working.
It does. And it's a profound signal. He's essentially shouting from the rooftops that the market is too expensive and that he cannot find good, solid companies at a price that makes any sense to him.
And let's be clear, when we say cash, it's not just sitting in a checking account earning nothing.
Well, absolutely not. That's a critical point, especially in today's high-rate world. That $200 billion is mostly parked in things like short-term U.S. Treasury bills.
So it's actually an investment position.
It is. It's a strategic asset. It's a low-risk machine generating a return of, 4.5%, maybe 5% right now. He's getting paid handsomely to wait.
And historically, when does he hold this much cash?
Only during times of extreme uncertainty or when he sees a market that's just grossly overvalued. Think right before the dot-com bust or leading up to 2008. He's getting his war chest ready for a time when valuations come back down to earth.
So his strategy isn't broad diversification at all. It's the opposite.
It is the absolute opposite. He is practicing concentration over dispersion. I mean, look at where his money is invested.
Yeah.
It's highly focused in sectors he feels certain about, like energy and specific insurance companies that do well with high rates.
And for everything else.
For everything else, he's holding cash. He's telling all of us, if you can't find a clear world-class winner, holding high-yielding cash is the smartest move you can make. The risk of being wrong in this market is just too high.
Okay, so we have the stats, we have the Buffett signal, but let's get to the why. Why is this happening right now, in late 2025? What is the engine that's driving this huge split in the market?
The engine, the core driver, is what some are calling the AI premium. We've hit an inflection point where these big tech companies are not just software companies anymore. They're not just selling ads or phones. They are now basically national, and in some cases global, infrastructure providers.
Infrastructure, like roads and bridges.
The modern equivalent, yes. We're talking about the fundamental building blocks of the 21st century economy. The massive data centers, the incredible amounts of power they consume, the communication networks, and crucially, the proprietary AI models that run on top of it all.
They own the digital plumbing.
They own the plumbing. And because of that, they can achieve growth rates that are just permanently disconnected from the rest of the economy. If the U.S. GDP grows at, say, 2 or 3%,
right,
these companies can still grow their revenue at 15, 20, even 30% year after year. And that creates this structural split. The stock market's value is now permanently growing faster than the real, tangible economy.
That's a huge point. It's like the financial economy is running on some kind of next-gen fusion reactor AI and IP, while the rest of the economy is still chugging along on a combustion engine.
That's a great way to put it, and you can see it in the valuation metrics. The price-to-earnings ratios for the M7 are just soaring because the market is betting on this sustained superior growth.
While the PE for the other 490 companies is, what, flat?
Stagnant or even declining. And this lets them spend billions every quarter, tens of billions, on building out that AI infrastructure. They're literally buying the future. And their cash positions mean they can do it without going into crushing debt, which their smaller competitors just can't do.
And that ability to buy the future while everyone else is struggling with debt, that brings us to the K-shaped bifurcation, right? This really explains that feeling so many people have that only the big guys are winning.
It does, and the current high interest rate environment is just pouring fuel on that fire. High rates aren't just a brake on the economy, they're a sorting mechanism. They brutally separate the companies that have cash from those that don't.
So walk us through the two arms of that K. Let's start with the winners on the upper arm.
Okay, so the upper arm, the upward swooping part of the K, that's big tech. They are sitting on mountains of cash. They have huge profit margins from the AI premium. So when rates are high, They don't really care.
Because they're not borrowing money.
They're not borrowing. In fact, they're benefiting. They're earning billions on those cash piles, just like Buffett is. It allows them to keep investing, keep buying smaller companies, and just cement their dominance.
And then there's the other arm.
Then there's the lower arm of the K, and this is the rest of the market. Small and medium-sized businesses, what you might call zombie companies.
A zombie company being one that can't even cover its interest payments with its profits.
That's the definition. And they are just being crushed by high rates. All their money is going to service debt instead of R&D or growth. They have no chance of competing in the AI arms race. They are being left behind permanently.
So the rising tide of the S&P 500 is only lifting the biggest boats, and the high rates are actively sinking the smaller ones.
Precisely. And the proof is right there in the market data. The NASDAQ 100, which is all those tech giants, it just keeps hitting new highs. Meanwhile, the Russell 2000, which tracks the small companies on that lower K arm, it's just struggling to get any momentum at all. This is a fundamental split in capital strength.
This all sounds pretty intimidating. I mean, a market that's totally dominated by just a handful of stocks, where the gap is structural. So let's pivot to strategy. How does an investor actually navigate this? It seems to challenge everything we've been taught.
It does. And the biggest mental shift you have to make is to challenge that sacred rule from every investment textbook. Broad diversification.
Whoa, hold on. You're telling people to basically throw out modern portfolio theory. To put all their eggs in one basket? Doesn't that just massively increase your risk? I mean, what if one of the M7 gets hit with a huge regulation? A concentrated portfolio would get wiped out.
That is the right question to ask, and it forces us to redefine what risk and diversification even mean today. In this market, where the top 10 stocks are driving almost 40% of the return, spreading your money across the other 490 struggling companies isn't reducing risk, it's diluting your returns.
They're actively choosing to own the underperformers.
You're actively buying mediocrity. The way you manage concentration risk now is not by buying worse companies, it's by diversifying into different asset classes. You pair your concentrated bet on quality stocks with things that are not correlated, like strategic cash or specific commodities.
So the new rule for picking stocks is what?
It's an absolute focus on quality. And by quality, I mean first-place companies, the ones with dominant market share, massive cash flow, and the capital to stay ahead in AI. If you're going to pick stocks, you have to stick with the established leaders. Stop chasing the next NVIDIA in the small cap space.
Let's put some numbers on that for a beginner. Let's say I had $10,000 to invest last year. What's the likely difference if I put half in 3M7 stocks and half in cash versus spreading that whole 10 grand across 50 small cap stocks?
The difference would be profound. The M7 stocks might have given you, 40, 50, 60% gains? But those 50 small caps in the Russell 2000, they were likely struggling just to break even, weighed down by interest costs.
So my diversified portfolio would have been dragged down.
It would have been dragged way down, maybe to a 10 or 12% return. While the concentrated portfolio would be soaring past 30%, the cost of owning those losers is just immense in this environment.
I want to talk about the psychology of this, though. That feeling of relative deprivation. It drives so many bad decisions. You see, the S&P is up 20% on the news, but you look at your account and it's only up 5%.
Right.
The impulse is to jump into those lagging stocks, thinking they have to catch up eventually.
And that is the most dangerous trap in this market, that catch-up hope. You're assuming it's a coiled spring, ready to pop. But like we said, the gap is fundamental. It's based on real differences in earnings and capital. That gap is widening, not closing.
So trying to get on them reverting to the mean is a losing game.
It's a costly mistake. If a stock is lagging the M7 this badly, it's lagging for a very good reason. It just doesn't have the moat to compete anymore.
So if buying the laggards is a trap, how do we adjust our core holdings to make sure we're not just left behind completely?
You have to make sure that the core of your portfolio, I'd say at least half of your stock allocation, must include these market leaders and the infrastructure they rely on.
So not just big tech itself, but the companies that support them.
Exactly. The power grid companies, the semiconductor giants, the data center builders. This is your defense against that relative deprivation. By anchoring your portfolio in these must-own names, you ensure you participate when the market goes up. You might not time the top perfectly, but you avoid that soul-crushing feeling of watching the index rocket up while your money goes nowhere.
Okay, let's circle back to Buffett's $200 billion in cash. This seems so critical for an investor to understand right now. Cash isn't just a leftover. It's a strategic position.
It's one of the most powerful positions you can have. In a concentration era, if you cannot find a clear, high-quality winner, you must not force an investment into a second or third-tier company. That is the classic mistake people make at the end of a cycle.
And right now, holding cash is an aggressive defense.
It's the most aggressive defense. With T-bills yielding over 4.5%, cash is basically a safe, high-yielding asset that isn't correlated to the stock market. It preserves your capital while you wait for a better opportunity.
You're getting paid to be patient. And what's the ultimate payoff for that patience?
Optionality. It gives you the power to act. If the market has a sharp correction, maybe a big tech company faces a lawsuit, or there's an economic shock, that cash becomes your weapon. You can jump in and buy those high-quality companies at a discount.
Whereas if you're fully invested in the lower K stocks,
You have no options. You just have to watch your portfolio bleed out. Strategic cash lets you buy the dip in the proven winners, not just buy mediocrity at any price.
this gives us a really clear framework for this concentration game then. Focus on quality, concentrate your bets, and use cash as a weapon. But those very companies that are driving this concentration, the AI and tech firms, they depend on global supply chains for everything they build: chips, batteries, metals. And that brings us to the second massive shift happening right now. The cost of those goods is fundamentally changing, and it's being driven by a policy shift in China. We're witnessing the end of the China price.
This is a huge macroeconomic story, and it's going to affect everything from your grocery bill to your portfolio. I mean, for 2 decades, China has been the world's deflationary engine. It exported cheap goods and kept a lid on global inflation.
Right.
But now, policymakers in Beijing are intentionally turning that ship around. And the data shows the deflationary era is over. China is shifting from being a deflation exporter to an inflation exporter.
The idea of everything made in China being cheaper has been a given for so long. It helped the Fed keep inflation low for decades. So now that deflationary buffer is disappearing, what's the hard data telling us this is really happening?
There are 2 major data points that show this isn't just a policy goal anymore, it's happening in the real economy. First, you have to look at the Export Price Index, or EPI. This measures the price of goods as they leave Chinese ports. For the first time in over 25 months, to be exact, China's EPI has turned positive.
So prices are actually going up.
They're going up. It's not a huge spike yet, but the simple fact that the direction has changed is a massive signal. It means Chinese companies are finally able to, and being told to, raise prices instead of just selling at a loss to grab market share.
And that means the price tag on goods here in the U.S. will start to reflect that in a few months.
Exactly. There's usually a 6 to 9 month lag. So the inflationary pressure for the first half of 2026 is already baked in.
And what's the second data point?
The second is the Producer Price Index, or PPI. This is the price at the factory gate. China's PPI showed a really unexpected jump, a positive flow of around 2.1% in the latest data. This is classic cost-push inflation. When factory prices rise, it means raw materials and labor are getting more expensive, and those costs are being passed on.
So factory prices go up, shipping costs go up, and eventually the price we pay as consumers has to go up. And this is all happening while they're deliberately cutting back on supply.
That's the other part of it. For years, China had this enormous manufacturing surplus. Some analysis suggests it was over 10% of their entire GDP. The government is now aggressively shutting that down, forcing consolidation. And when you intentionally shrink supply in key sectors, you force prices up everywhere.
This isn't just the market, though. This is a deliberate, top-down policy decision coming from Beijing. Explain this concept of anti-involution. It sounds academic, but it seems to be the key here.
It is the key. Involution is a term they use for this cycle of self-defeating competition. Chinese companies were in such a brutal race for export dominance that they would cut prices to the bone, sometimes selling below what it even costs them to make the product.
Just to win market share.
Just to win market share. And it cannibalized their profits and left them with mountains of debt. The government realized this was totally unsustainable. So the anti-involution mandate is the policy to stop this suicidal price war and force companies to focus on quality and profitability.
And how are they enforcing that? What are the actual rules?
Well, it became official on December 1st. China's Ministry of Industry and Information Technology, the MIT, rolled out new guidelines, and they're specifically targeting the sectors where this was the worst: solar, batteries, and electric vehicles.
What's the main restriction?
The main rule is a strict prohibition on selling below cost. It's a direct attack on those price wars. And on top of that, they're mandating the closure of older, less efficient factories that can't meet new standards.
Wow. In sectors like solar panels or EV batteries, where Chinese firms make up, what, 70 or 80% of the global market,
Right.
taking away their ability to dump product below cost basically guarantees a global price hike for all of those essential green technologies.
It does. The whole point is to normalize their profit margins. It means the rest of the world can no longer rely on China for artificially cheap deflationary goods. We are now relying on them for cost-push inflation.
Okay, that transition from deflation exporter to inflation exporter, it's a tectonic shift. If that global price stabilizer is gone, what does that mean for the Federal Reserve and for our portfolios? Who wins and who loses here?
The biggest macro implication is that the foundation for the super low interest rates we all got used to after 2008, it's just gone. It's dissolving.
For years, central banks had this tailwind. Global supply chains were always pushing prices down, so the Fed could keep rates low without inflation getting out of control. That buffer is gone now.
It's gone.
Yeah.
When you remove a powerful structural deflationary force like that, the Fed's job of hitting a 2% inflation target gets a whole lot harder. This inflation from China is sticky. It's not something they can easily control.
So this confirms the higher for longer thesis.
It absolutely confirms it. We are not going back to near zero rates anytime soon. It's far more likely that rates will stabilize at a much higher average level, think maybe a floor of 3 to 4%, than people were hoping for.
Which means, as investors, we have to stop betting on rate cuts and start building portfolios that can survive sustained high rates.
Precisely. You have to prioritize companies with strong balance sheets. And this links perfectly back to our first segment, those zombie companies on the lower K arm. They're now facing a double whammy, high borrowing costs and rising input costs from China. They're going to be the first casualties.
Okay, but in every big shift, there are winners. Who benefits from rising Chinese prices? What sectors get their pricing power back?
This is a massive opportunity for industrial and manufacturing companies outside of China. For decades, they've been undercut by Chinese dumping and have been fighting for survival on razor-thin margins.
But now their biggest competitor is being forced to raise prices.
Exactly. When the Chinese firms have to stop underselling the market, other global companies can finally price their products profitably without losing all their business.
Can you give us a few concrete examples?
Sure, look at basic industrial materials. Global steel companies like ArcelorMittal or U.S. firms like Nucor. For years, they've been crushed by cheap Chinese steel imports. Now they're going to see their pricing power and their margins improve dramatically. It's a structural shift in their profitability.
And what about in the green energy space?
It's the same story, maybe even more pronounced. Non-Chinese solar and battery makers like Hanwha Solutions or LG Energy Solution, they're going to get some breathing room. The intense pressure from low-cost Chinese dumping will ease, allowing them to expand their margins and actually invest in their own growth. It's a huge shift from defense to offense for them.
So, given that we are now in this structurally higher inflation world, we need to talk about protecting our purchasing power. What are the essential inflation hedges?
They're no longer optional, they're essential. I'd point to 2 core types for this environment. First, commodities.
Because of the supply and demand story?
Exactly. China is reducing its industrial capacity, which creates supply uncertainty for raw materials. At the same time, the massive AI infrastructure build-out is creating huge demand for industrial metals.
Like copper and aluminum.
Copper, aluminum, specialty chemicals, yes. Investing in these through ETFs or related stocks is a fantastic inflation hedge. They are real, tangible assets that hold their value when inflation is eroding the value of a dollar. I mean, copper is in every data center, every power line, every EV battery. Its value is tied to this physical build-out.
And the second hedge is more financial, for capital preservation.
Yeah.
Let's talk about TIPS.
TIPS, or Treasury Inflation-Protected Securities, are perfect for this kind of sticky structural inflation. A normal Treasury bond pays you a fixed interest rate, so if inflation is higher than your interest rate, you're losing money.
You're losing purchasing power.
Right. But TIPS are different. Their principal value, the amount you invested, is adjusted upwards twice a year based on inflation. So if inflation is 3%, the principal your interest is paid on also goes up by 3%. It protects your original investment from being eaten away by inflation. It's an essential tool for a higher for longer world.
We've covered the winners and the hedges.
Yeah.
Now let's name the losers. Where are the most vulnerable spots in the market from this end of the China price?
You have to look at any company whose entire business model was built on the idea that they would always have access to cheap Chinese parts and components.
The assemblers.
The assemblers, the distributors, firms that buy cheap parts, put them together with very little of their own IP, and sell them on a thin margin. If their input costs suddenly jump 15% because of this new Chinese policy, their whole model just collapses.
What sectors are most vulnerable?
Think mass market consumer electronics, fast fashion apparel companies, and especially some of the discount retailers. The business model for a dollar store, for instance, is completely dependent on an ultra-low cost of goods. They can't withstand that kind of input cost shock.
So the key thing for an investor to look for, or rather to avoid, is weak price transmission power.
That's the phrase. You have to avoid companies that cannot easily pass on their rising costs to their customers without seeing their sales completely crater. If you're selling a commodity-like product, like a cheap t-shirt or a basic electronic gadget, you're caught in an impossible squeeze. Investors need to be ruthless about analyzing this. If a company can't raise its prices, it's going to end up on the lower arm of that K.
This has been an incredibly detailed breakdown of this dual reality we're facing in late 2025. We've got two huge connected forces. First, concentration, where the market's fate is in the hands of a few giants, demanding a laser focus on quality. And second, inflation, where global costs are rising permanently, confirming that higher for longer is here to stay.
And the final takeaway for everyone is this. You have to ditch the old department store approach to diversification. You either need to concentrate your capital in the super companies that have the cash and the moat to win, or you hold strategic, high-yielding cash. And at the same time, you have to prepare your portfolio for higher costs by owning companies with real pricing power and building in those inflation hedges like commodities and TPS.
And as a final thought, these two themes are deeply connected.
They are. Think about it. The companies winning the concentration game, big tech, they're winning because they own the essential digital infrastructure. And they're going to win the inflation fight because they have the ultimate pricing power. They can pass on any rising costs for power, for copper, for components because their services are indispensable.
The owner of the foundation always wins.
The owner of the foundation, whether it's digital or physical, will always win in an era of scarcity and rising costs. And that's the thought you should be mulling over as you look at your portfolio for the next decade.
That is a fantastic and challenging thought to end on. The key is owning what the economy cannot live without. Thank you for making these incredibly complex shifts so clear for us. Don't forget to subscribe and hit that like button.